It's the emotional biases that get us into trouble. When things aren't working a certain direction, the way we think they were, or should, or would, or could, then all of a sudden we start kind of panicking. And this is when we make bad investment decisions and we sell at the bottom. We buy at tops. We do exactly all the things we shouldn't do. But you need to have your rules written down and make sure that you don't violate your rules, because when you start taking an action, and if you look over at your desk and go, wow, if I do this, I'm violating that rule, then you probably shouldn't do it.
You're listening to The Real Investment Show.
The biggest mistake that most people make, and includes me, right? So everything I'm talking about with you right now is personal experience. And, we all learn through the school of hard knocks over time, and we never stop learning from that, right? We will always make mistakes in investing. We will always make bad decisions. Decisions that we do make won't work out the way that we think they will. And then how we react to those decisions become another issue. Good example. Just recently had an exchange of emails with an individual. And they had sold all their stocks previously, gotten into bonds, 100% bonds, because they were losing too much money in stocks in 2022. So make the obvious switch. I'm going to go into bonds because bonds give me protection, right? So yields have gone up, so the bond prices have gone down. Now forget the fact that bonds are going to mature at face value, right? We're not talking about that. If I just hold the bonds, I get all my money back plus my interest payments, and I have a very calculable rate of return. But emotionally, we get tied up into, now I'm losing. I was losing money in stocks, so I sold everything. Now I'm invested fully in bonds, and I'm losing money there. I need, what do I do now, right? So we get ourselves kind of trapped in these positions. And this is what happens when you don't have an investment process, right? And your investment process can't be just mentally. It's got to be written down. You've got to have a written policy that you keep it on your desk, right? That you can refer to. I've got a list of rules that I keep on my desk, and we have an investment policy statement that is written, sitting on my desk. And so when I get myself in, when my emotions start to arise and I start feeling pressure to do something, right? I go back to my rules and I reread my rules, because it's the emotional biases that get us into trouble, right? When things aren't working a certain direction, the way we think they were, or should, or would, or could, then all of a sudden we start kind of panicking. And this is when we make bad investment decisions and we sell at the bottom, we buy at tops. We do exactly all the things we shouldn't do. So importantly, and I've got a list of New Year's resolutions coming out on the website, I think on Friday. I've got rules about portfolio management coming out the week after that. It's every January I have a couple of articles that I produce that are just kind of your setup for the year, right? Just trying to get you in a good place. So those will be coming out over the next couple of weeks. We'll talk about them here on the show. But you need to have your rules written down and make sure that you don't violate your rules, because when you start taking an action, and if you look over at your desk and go, wow, if I do this, I'm violating that rule, then you probably shouldn't do it. And, look, markets are going down, you can sell short. Problem is, for a lot of people, they sell short, they don't know when to close out their short. So then they wind up losing money on the short. They're a long-only investor. Markets go down, they start panic selling their longs when they should be buying their longs, right? All the things that we do wrong. So again, have a set of rules written down. However you generate them, whatever and look, everybody manages money differently. And if you can't write down a list of rules, then I would probably go hire somebody to manage my money for me. Because if you can't even come up with a set of rules to manage, you really should. It's like driving without understanding how to drive. So if you can't even come up with a list of basic 10 rules, if you can't write down 10 rules and put them on your desk of things that you should and should not do to manage your own money, then don't manage your own money because you're kind of flying blind. And it's a good test for yourself, right? It's just a really good test to see really if you understand what you're doing. And if you don't, hire somebody else to do it for you that can. And ask them, what are your rules? Let me see them, right? They should be able to produce them. Because any good manager will tell you, they do, you go talk to any good professional manager, they have a written investment policy statement, they have their investment rules, they track their trades, every trade they make, they have them written down somewhere. They say, I bought this, I sold it here, this was the result, right? So that's just kind of a good primer for finding somebody to manage your money. And look, things go wrong, right? Things happen because markets on a short-term basis do things that have nothing to do with the long-term fundamental drivers. And look, long-term fundamentals matter. So don't get me wrong. We talk a lot here on the show about short-term movements. But fundamentals matter, and they matter a lot in the long term. Earnings growth, valuations, economic growth, those things matter very much to the long-term returns of markets. Just not over a 3-month or a 6-month period. So if bond yields do something because of an economic report today, that doesn't change the dynamic of what drives bond yields long term. If stocks go down sharply today because of some report, that doesn't change the long-term driver if earnings are growing. Now, if earnings aren't growing, that's a different story. If the fundamental drivers that back interest rates changes, that's a different story. And so when those things change, then yes, you need to change your theses, et cetera, and then make your decisions from there. But one of the mistakes that, or actually I'd say probably the biggest mistake that all investors make is they allow short-term movements in the markets to impact their long-term investment decisions. And that happens because you don't have a policy statement written down that you can refer to and say, okay, my emotions are getting to me. Let me go back to my policy statement. What is it that I'm trying to achieve? What is it I'm trying to do? And that policy statement should contain a few things. It should contain, how do you come to your investment decision? If I'm going to buy a company, a stock, right? How do I come to the decision of buying the stock? Did I buy it just because it's going up and somebody on television recommended it? Or did I actually do some analytical research and understand the fundamental drivers of that company and its positioning in the markets, its market cap? Does it have a moat? Does it provide a dividend yield? What's its payout ratio? What's its history of payouts? All those things. Then you should also have in there, not just how do you come to that decision, is how do you make the purchase of that position? When do you sell that position? What drivers are you looking for to determine my thesis is no longer valid, I need to now sell that position? That should all be in your policy statement. And if you'll do that, just the simple exercise of writing things down will make you a better investor, because it will start to crystallize how you approach the buying and selling of your positions. And again, the buying part is easy. When things are going up, we just buy stuff and they go up and we're all happy, right? The hard part is knowing when and how to sell things. And that's what a good investment policy statement will do for you. You know, for instance, our investment policy, the what we work with, has been just developed over years and years of hard knocks, right? What we got right, what we got wrong. Oh, that didn't, that rule I thought was a good rule wasn't a good rule at all. That was a terrible rule. Got to change it. But that's how you get there. And so, part of your process, if you sit down and start this process and you think back to all the mistakes you've made over time, write that down. I did this before. I'm not going to do it again. I sold all my stocks to buy all my bonds because, of whatever reason. Don't do that. You should never go from 100% stocks to 100% bonds. Bonds provide a very important ballast to your portfolio. You should own bonds in your portfolio. They provide stability. They lower volatility. They provide a whole lot of benefit. They provide a steady stream of income. whole lot of reasons to own bonds, but it should never be a 100% bond portfolio because you need the inflation adjustment from equities over time. Same concept is, I really don't recommend owning 100% equities unless you're young. Now, if you're young, if you're in your 20s and 30s, you don't need bonds. Just buy equities, hold your nose, and just make sure they're good companies. Buy an ETF, you'll be great. But as you're getting older, having 100% in equities becomes way too risky for your capital because if something breaks, like 2008, and you have an event that comes along that disrupts the economy to a large degree, that devastation can really impact your retirement. So having too much exposed to risk also has its consequences. But again, that's something you have to come to personally. That's your personal decision in your investment policy program about how you manage risk, how do you manage volatility, what is your goal? And one of the most, I'm like right there at the top of your page, right? Your investment policy statement. It should say, my goal is to generate 5% a year, 4% a year, 6%, whatever the number is. And big bold letters. And then don't worry anymore about what the S&P does from one year to the next. Don't worry about what the NASDAQ does from one year to the next. Worry about, did I meet my investment goal for the year? And if you do that, you'll wind up being a much better investor over time. Okay. Have a great day.